Good afternoon, everyone. Thank you for your patience. I had to start a few minutes early to make sure everything's working properly. Because I'm in the Nevada office today, I don't have the brilliant technology wizards of Pitch Hub with me, so it makes me a little nervous making sure it's all working well. Seems like it is. So that being said, thank you everyone who is here live, as well as those of you who have registered. A lot of registered people this time, which I really appreciate, because usually we do the December one live, but this year it's a bit different. So we're going to do the live one in January. I'll just give you a little information. I believe it's the 18th of January. We're going to host it at the Hotel Paradox in Santa Cruz. Really easy place to get to for those of you over the hill, as well as those of you in Santa Cruz County. We selected the location to be traffic advantaged as much as we could. And for those of you who cannot come in person, of course, we will be doing it by Zoom as well. But save the date for the 18th if you haven't already gotten that. That will be our traditional live event with our special guest speakers. So that being said, I certainly didn't want to make everyone wait until January for a look ahead at 2024. So I thought this would be a great chance to do the webinar version, the recorded version. As always, please send in your questions. Really want to make sure that everybody gets the most out of your time here today or in the future for those of you who are watching later. And all of you who sent questions in advance, I have answers for you, and I've incorporated a lot of that in the notes today. So just wanted to, again, make sure everybody gets the most advantage out of today. Ask questions, please. Before I start, I did want to bring up a couple of things that my team wanted me to mention. Because sometimes I'm so busy taking care of clients and their needs that I'm not always good at projecting out some things that Sequoia is doing that you may or may not know about. So I wanted to bring up these things that are available to all of our clients, and any of you who are not clients, this can be available to you as well, but especially for clients to know this. One is LPL sent this out over a year ago now to upgrade your account view, your online access to your accounts to 2.0. It has a lot more features, a lot more robust, can do a lot more things with it. So if you haven't signed up for that, or if you haven't seen changes, please reach out to us. Caitlin will get you set up. Because of security, we have to do it on an individual basis, give you the links, but just be sure you got the most advanced technology to view your accounts. Also, just as a note, the regulators prohibit texting for business purposes. I cannot text you. If you text me, I have to call you or send you an email. This is not us. We would love to text you. We would love to receive texts from you, but this is a regulation from the SEC. Sequoia's looking at some technology that we'll be able to set up a special texting communication tool with our clients. So if you like texting, if you would prefer to communicate that way, let us know so we can set you up on this program. And we'll be able to do it in a compliant way. Again, SEC rules, not ours, but we really want to make communication with us really easy, the way you like to communicate. Also, as a reminder, we do tax planning. Really good, important thing to know. We are not CPAs and we do not file your taxes, but we can do some really great tax planning and tax strategies. The service is available free of charge to all of our clients. If you're not a client of Sequoia and you can still use these services, we charge a modest fee to do so. Tax planning is a really great service, and it really ties well within the work your CPA is doing for this reason. CPAs are backwards looking. You send them all your information, they tell you how much you owe, or if you're lucky, how much you're getting back. But it's not as effective for long-term tax planning, tax mitigation, tax strategy. That's what we do. So the two really work well together. We can work closely with your CPAs on this as well. And our experiences, the CPAs love our reports. Really helps them do their job better as well. So please, if you're interested, reach out. We'll just do a meeting to get the information we need, copies of your tax returns, which you can securely upload. Please take advantage of this service. We use it a lot in our financial planning, and we really want to make sure that you're getting the full benefit of your relationship with Sequoia. That being said, and also a reminder too, for all of you that are only doing investment work with Sequoia, financial planning is available to you as clients of Sequoia, not only for you, but also for your family members, right? So your children, your parents, other family members, we really look to serve our clients in a holistic fashion. So please reach out to us and let us know if this is of interest to you, and we'll get you all set up for it. That being said, thank you for your patience with all that. I just want to make sure you get that information out. And without further ado, I will jump into the outlook on the economy. So usually what I do at the last meeting of the year is I talk about what I was saying in the early part of the year and where I was right and where I was wrong. Of course, anything that you're projecting into the future, there's a lot of variables that you can't know. And sometimes it's flows pretty well, like this year, pretty much in line with what I was saying back in January. And some years it's a big surprise like 2020. So that being said, we're pretty much kind of tying along with that right now. The Fed at this point, and I'll talk a little bit more about that as I'll reach at least a stopping point with interest rate increases, though they're not going to cut anytime soon. Again, I'll talk about that in a moment. The markets are a bit perky right now. Unfortunately, though, they're sort of pulling ahead next year's growth because we're getting really close to kind of how we see the markets ending at the end of 2024, which will involve a little bit different planning going into next year, which again, I'll talk about as well. Primary reason the markets are really excited right now is inflation is moderating and the Fed is taking a pause. And the biggest fear of the markets was the Fed would overdo things and not slow the economy down, which is their intention to control inflation, but actually take it into a crash. That has not happened to date. In the broad economy, it's actually doing quite well, but it is slowing down. So as expected, last quarter of the year, things are beginning to slow down, and that will probably continue into next year. I want to bring this up because this is the biggest #1 question that I have gotten, both for the purpose of this webinar and also from clients, is where's the recession? Are we going to have a recession? When's it happening? Because there's been so much talk about that. And as I mentioned early in the year, it's really, I never ever saw it as we were going to have a recession. It was certainly a possibility, still a possibility, but it's not a certainty. And the reason I think a lot of people expect that is the last 2 times the economy went down, yeah, I'm going to take pandemic COVID out of this, really was bubble driven. Excess in the economy, excess during the .com, excess during the housing bubble and the debt around that. And those excesses, they tend to lead to crashes. They tend to lead to these big drops in the market. I'm going to take my glasses off because they're driving me crazy. That tends to happen. When you have these extreme bubbles and they burst, you tend to have this crash. And so because those are the most recent experiences people had with the down markets, that's kind of the imprint that's on people's minds of this is what's going to happen when the economy slows, we have recession. This time around, it's all policy driven around the extraordinary stimulus. Some people would say excessive stimulus during the COVID period, not during the initial part of the COVID period. During 2020, it was critically important that the government stepped in and supported the economy as we were shut down. 2021, not so much. We had a vaccine, the pandemic was waning, but it's really hard for the government to stop spending when they start. And so we kind of spent more than we needed to, longer than we needed to, and that led to obviously inflation. There were other things that led to inflation as well, but because that's past, I won't go into it too much, but that was extraordinary. So that was policy driven. The policy driven on the back end was the Fed jumping in and raising rates as quickly as possible, historically fast as possible, to try to control inflation. And that, of course, led to massive disruption and a lot of stock market volatility around that period of time as the Fed was trying to get control over this. So the Fed's attempt is to slow the economy to get inflation under control without bringing it to a full-on crash. That's what they've always been the intention. They call it the Goldilocks economy. So far, they've been able to manage that. Will they be able to continue? It is unknown. It is unknown. A lot of opinions on this, but there's a lot of factors. Because don't forget, the consumer, 2/3 of our economy, that's you and I and everyone else out there spending money on stuff. And the consumer has been incredibly resilient through this time, even with higher rates, even with all the disruptions, the consumer has kept spending. That is beginning to slow, but it's not crashing. It's slowing. It's slowing because things are more expensive. It's slowing because demographics, more people getting close to retirement, getting more cautious, it's slowing in a lot of ways, but it hasn't ended. And that is really what's kept the economy going. Another thing I mentioned is that the third quarter was going to be amazing as defined by GDP. It was, but that is an anomaly and it will unlikely be even half that this quarter. So it's, again, the slowdown is coming, but it's not a reason for fear. It's a reason for adjustment. Adjust for a slowing economy, but not, again, a crash at this point, barring any shocks to the system, which a lot of questions came about that, which I'll answer later on. Now, one thing I do want to stress, I'm talking about the economy in very broad terms. If you have a personal event that happens, if you lose a job, someone gets sick, your economy becomes very different very quickly. That is why planning is important. Plan for a disaster. So if it happens, you're prepared, but don't fear a disaster. And I use my story, which kind of exemplifies this. You go to the beach, it's a beautiful sunny day, you're having a picnic, you're swimming in the water, you're having a great time with your family. You see those clouds in the distance. Looks like there might be a storm, but not now. So enjoy the moment, enjoy what's there, but do plan what you're going to do if those clouds get bigger. That is the whole concept of planning. All of this right now, what's tying into this is the Fed is trying to find the balancing point, which is how much inflation will they accept and how quickly or not to stop raising rates or cut rates, because that's the other big question that comes up. The thing I want to just bring up, this is a little technical, so I'll try to explain it because this will help hopefully make a lot of this make more sense, is the Fed tries to find what's called the terminal rate, which is the interest rates which control inflation, but allow the economy to grow. And it's a balancing point because there's so many dynamics that are constantly changing, and most of them are not in the Fed's control. They only have a few tools at their disposal that they're using. Government spending is a big one. They can't stop the government from spending. Government spends, they have to adapt to it. They can't stop the consumer from spending or not spending. They have to adapt to that as well. They can't control macroeconomic events. They can only adapt to it. So this is a constantly moving target. So while it's very likely that the Fed will cut rates, as soon as the second quarter is possible, more likely the third quarter or later, okay? And I'm just setting that up because that's a big question I've had. But they're not going to go back to where they were, not even close. We're looking at, right now we're about 5.25, 5.5. We're looking at, that's the rate. We're looking somewhere around 3.5, maybe as low as 3, maybe as high as 4. But that's probably where they're going to stop, at least for now. Because they have a bigger challenge here, which is that inflation will moderate, but it's not going to go away. And it will likely come back later in 25, 26, somewhere in that range. Too difficult to predict exactly what year. We're too far away because we have some really big issues here, which is demographics. The cost of the entitlement programs is exploding. Okay, entitlement programs defined by Social Security, Medicare, Medicaid / Obamacare, all of the government spending in those entitlements is exploding. It's 46% of government spending right now, just to get an idea. And it's growing fast, and it's going to grow much faster because we have so many people aging into the systems. That is going to happen regardless. That's a demographic thing. There's not much we can do about it. We want people to live a long time and grow older. It's just the nature of the beast. But it costs a lot of money, and it's taking more and more and more of the government's revenue, which is going to keep costs higher. So demographics is a big one. The other one is deficit. The debt levels of the government are also exploding. These also will likely keep rates higher and keep inflation higher. So those two things, government spending is, yes, controllable, depends on our politicians and the choices they make. It's really, really hard to get our politicians to tell us things we don't want to hear. Why? Because they want us to vote for them and elect them and re-elect them. If not them, their party. They don't want to tell us the hard things. They don't want to say to us, hey, you know, we got to cut back somewhere if we're going to spend all this money on this program. They don't have to say it, they don't say it, and that's just the nature of the beast of politics. And so government cuts spending somewhere, spends less on new programs, or raises taxes. Raising taxes is a really challenging thing too, because if they raise taxes too much, they can also squash innovation. They can squash investments. They can squash what is developing all of this growth for the future, which produces more revenue for the government in the future. So finding that balance is a challenge, and there's a lot of different opinions about how that should be done. So a lot of it's political, a lot of it's social, a lot of it's personal. That philosophy of, I want this stuff and somebody else should pay for it. And how that is just depends on what your viewpoints are in that space. But it is a big issue, and it's not going away anytime soon, which I will say for the in-person event, talking a little bit about where this is all gonna, where the chickens are gonna come home to roost later this decade, and where the really significant issues are gonna fall and how we're gonna prepare for that. So I wanted to bring this up, is that inflation will moderate. It will continue to moderate as the economy slows. The Fed will likely cut later next year, but they're not going back anywhere close to where they are. What does that all mean to you? It depends on the plan. The good news that's come out of this is that we can actually get really, really good income from conservative places. Finally, the savers of the world can be rewarded. This has been exciting. Nothing I'm saying here is promissory, and these numbers can always change. But right now we're seeing in our money markets well over 5%. We're seeing multiples of that in municipal bond space. especially with the tax advantages thrown in. Conservative investments are finally paying investors. And that is a really good place to be because it can balance a portfolio with people not having to necessarily take on more risk than they're comfortable doing, but still get some rate of return. Again, none of this should be construed as recommendations or advice. This should be done on an individual level. But this is a thing that is really, really helpful, is that we can get some returns in conservative places. However, if the returns in conservative places are higher and your cost of living is going up due to inflation, is that really helping? So this is where planning strategies come into place to help to moderate that and minimize those effects as much as possible. Inflation is likely going to come back, as I mentioned. Again, it's hard to say exactly when. Right now, it looks like the economy is going to moderate into next year, but 2025 is still looking like it's going to be a growth year. So depending on when in 25 that happens, and when we see that trip, I guess, more inflationary, it'll be later in the year. So this is going to be important for a planning thing as well. So we'll be keeping a close eye on that, and also adjusting that within client portfolios and in clients' financial plans. So that was a big one. The Fed, I hope I covered a lot of things there. Next year, slowing economy is always tricky because I give you these big national numbers and they don't necessarily feel relevant to your life. How is it going to be relevant to your life? It depends on your economy, right? What are your costs, right? What are your sources of income? How secure are they? What is affecting that? What's changing it? That's why personal planning is so incredibly important in this, because you want to know how you will navigate through this period of time. Next year, big things that are coming up, that are just kind of interesting little things that are coming up. This one is not planning really at the moment, but it could be huge. The Supreme Court is reviewing, or whatever the word is called when they're doing a case. It's called Moore versus the United States. And why does this matter to you? Because on a very high level, there was a couple, I think up in Washington, that invested in a foreign company, and they've never gotten any money from their investment. Their investment was relatively modest, but the IRS came back and penalized and charged them a tax bill on that. Traditionally, you do not get taxed until you have a gain or income on an investment. However, because they took this to they took this up the court system and the Supreme Court is hearing it, there is a possibility that we could potentially review or look differently at tax law. So there is a possibility that the results of the Supreme Court ruling could give the government an opening to, in the future, start taxing on unrealized gains or on assets. Don't want to use this as a scare tactic. I don't want to use it to keep people awake at night, but we have to watch this closely. The reason being is that right now you own a house. There's no taxes due, except property taxes, of course, until you sell the property. And depending on how you sell the property, maybe not even then, maybe it's deferred through a 1031 exchange or other vehicles. You have portfolios that you're not using. Maybe you're just being taxed on the income. What if that portfolio now became a taxable event? So the ruling on this really depends. The makeup of the Supreme Court currently makes me think that it won't be too onerous, but you never know. They've surprised us in the past. They'll surprise us in the future, but I'll be keeping a close eye on that. I'll certainly let you know how it looks. The results of that ruling is only what the government can do. It doesn't mean that's what they will do, and it will largely depend on who's in charge in Congress and the White House in the future. So again, just as a heads up, just because you may hear things about it, also some things you hear about it could be super scary. A lot of that probably won't come to pass, but just be aware of it. Because really what comes out of Congress is some of the biggest impacts on your financial plan as well as our economy. So I watch that stuff very closely. It actually matters a lot more than who gets elected president of the United States. It's really what gets done. And I'll give an example of this is the Biden administration, when they first came into office, and the Democrats kind of ran the show, they tried to pass a very significant tax reform or tax change, which would have had a huge impact on our clients, on many Americans. I won't get into the good or bad of this. I understand it's dangerous when you say anything about politics, but I will say the impacts would have been huge. And I was watching that very closely, and it missed passing by 1 vote. So that's how close and how quickly everything can change. When these laws pass, of course, we review all of our clients' financial plans, and we inform any clients of any changes that have to happen. So again, our job, but if you ever hear something, please reach out to us, and if you ever have questions that affects you. But I wanted to bring that one up. Another thing, next year, obviously we all know it's an election year. I'll talk a lot more about this when we have more clarity on who the nominees are going to be. Assuming obviously Biden on the Democratic side, on the Republican side, it's still being determined. So I feel like when we get a better sense of the economic policy of the candidates, as well as potentially how Congress can go, I'll talk a little bit more about that from an economic perspective. So I'll put all that stuff aside for now. Sorry, I'm just check the notes here. Let's see. And the other one I wanted to bring up, so that was kind of the high level. Markets really matters what you own. I know I've said this more than once. It's not just making the highest return, it's also protecting on the downside. The more return you get, the more volatility you have to withstand. I think most people know this. So it's always a good reminder to let me know anytime the volatility is uncomfortable, because it is part of the price we pay for these returns over time. I do my best to navigate it, but it's impossible to know the day to day. They're really important to always let me know, say, hey, you know, this is not really comfortable. Is there any other options available? There may well be, and I can easily restructure things. Just a reminder, when markets go up, markets go down, there's a trade-off. There is a place for many clients to have money conservative. Maybe you're going to start to use that money soon. Maybe you sleep better at night. Now you can get paid to be there. It's not a bad thing. Don't get stressed when the markets run up and it's not going to grow either to the same rate. So there's a trade-off. That's why the buckets of money doing different things at different times is so important for the success of it, because next year we'll probably continue to see well-funded, well-run companies in the right space that are adapting quickly to the technological changes taking place are going to significantly outperform companies who are not. It's not the time to have an index. It's a time to say, hey, we want to be better, more positioned in this specific area. Not trying to time a market, only because the cost of debt is rising and it's going to stay high for the foreseeable future per the Fed. So this will impact a lot of companies' balance sheets who carry a lot of debt. We really want to see that. It doesn't necessarily put the company in danger, but it could certainly impact their growth as more of their revenues being put towards servicing debt and they're refinancing this at higher rates. So again, sorry to get a little in the weeds there, but what we own matters, and what you own matters to what is the purpose of this money in your financial life. Way more important than what the S&P 500 did today. If you have questions about that, let me know. One thing as a reminder, as I spent an extraordinary amount of time reviewing and working on your portfolios and working with Katie on your financial plans. And I'm as good as our last conversation. So if you ever feel like something important's come up in your life, please let me know. I'll find a time, we'll talk about it just to make sure it's part of the plan and it's incorporated in there. In fact, this time of year, maybe a little bit of an apology, and that may be a little bit harder to get scheduled with or reach, is because this time of year is, this is my holiday present to you, dear clients. It's called tax harvesting, in which I review each of your portfolios individually, very carefully, harvesting out anything I can do to make your tax picture more attractive come tax season. I always call it the gift you don't know about. You don't see it on the performance reports, but you definitely notice it at tax season. It's a lot of work. It's a lot of attention. Because each of you is customized, it allows me to do this custom surgical types of work. Sometimes there's nothing need to be done. Sometimes there's a lot, and then there's adjustments. So why I'm bringing that up to you, not to try to say, look how much work I'm doing, because you guys already know I love it and I'm spending all my time doing it anyway. I bring it up to you because if any of you have had a significant gain, either in a portfolio you're trading yourself, your kind of fund money, you've sold property, you've sold a business, if anything's happened to you financially, please let me know. Send me a quick message, because I might be able to do something on my end to help mitigate that. But if I don't know about it, I can't. So please let me know. If you're not sure, if you let me know, just let me know. It's fine. I start really early in the morning. If you get me an email at night, I'll see it the next day and I'll make sure I incorporate that into your plan. You'll laugh because I get so excited when I'm doing it. I'm like, I just saved so-and-so $10,000 in taxes this year. Yay. It's really meaningful because it makes a difference in the plan. And sorry, I get really excited about that, but it's just kind of how we do things at Sequoia. But again, please let me know, because sometimes something I don't know about or something's happened outside, really, I might be able to do something on the portfolio, especially on taxable accounts. This also goes to, if you have friends or family or someone that is really concerned about year-end planning, I am working very long hours. I have 0 vacation plans. If it's important, I will make the time. I will answer your questions. I will answer their questions, because I'm here to be in service. They do not have to be a client. I will do my very best to at least get the answers that they need to get the things done by the end of the year. So please, the year's ended quick. Make sure to reach out to me. Okay, let's see the other areas. So that's kind of the high level of the markets. Areas of biggest concern right now, it's that heavily leveraged companies, startup companies where funding is starting to dry up because money is being sucked out of the system. Companies that are not adapting to technological changes, companies that have overhired and are not making those adjustments. There's a number of things. This has to be looked at by company level. Also, looking ahead too, there's a lot of opportunity overseas. There's a lot of areas of great growth and opportunity overseas as well. So this is not just about the US, and they're a little bit different of the cycle than we are. So that's something to look at not only now, but also into the future. In the more conservative spaces, like I mentioned earlier, we can get better interest rates in a lot of areas, but there's a lot of risk out there as well. Not a week goes by when someone doesn't say to me, hey, I have this, or I found this investment that's paying me 7%, 8%, 9%. These are leveraged a lot of times. These are risky investments, and people don't always understand how they work. And the thing is that in the fixed income space, you can actually really lose your money. Stocks tends to be more volatility. Yes, companies can go bankrupt. Yes, companies can go off the exchange. It's less common, especially in large, well-established companies. But in the fixed income space, there's a lot of risk out there. So really make sure you know what you own, because I would never want to see a situation where someone lost money that is conservative to them, or money that should be protected. So just make sure, again, happy to give you the information you need, but that's where I see a lot more of that risk out there right now. Another risk is a little bit different of a risk. It's more of an opportunity loss risk. A lot of people become very fearful and kind of put all their money not under the mattress, but in money market. Money in money market is really what you want to do when you want to hold money for a potential downdraft next year to buy stocks lower, or you hold money that you're going to spend in the short term. But when the Fed cuts interest rates, that interest will decline at the same rate, right? So that money that you're getting looks great now could be a lot lower in the future. And you want to make sure that you're not getting too conservative and it's putting your financial plan at risk. So there's a balance there as well. Again, can't stress enough the importance of financial planning, because you're going to know what you need and when you need it. And it's easier to understand how your money's invested and how you're getting there. So that's very important. The final area, I guess I want to just touch upon risk is government policy and regulation. It doesn't really matter who's in the White House or what Congress is doing. Laws, policy, things that come out of Congress have huge impacts on companies, either through a lot more regulation or determining where money is going to flow from the government. In other words, we're supporting this system, this program, this way of doing things. So we're going to put a lot of money here, and all of a sudden these other companies are hit. These other sectors are hit because the government is trying to control the economy. Again, I will not get into the right or wrong about this. This is something where there's a lot of different opinions, but it is a risk on the system because the economy is best left alone with guardrails, because it's allowed to organically go through the cycles that it needs to go through and live its life. Maybe it's a lot like raising kids, right? Narrow guardrails when they're small, and as they get older, you put bigger guardrails, but you try and keep the guardrails on there so they can grow and free and develop. But there's also some systems in place to protect. When the government gets too involved in trying to dictate the winners and the losers, or where the money is going to flow, it can sometimes stifle and crush innovation in other areas, or give advantages to companies that are not particularly well run or don't have a service or a need for the greater economy. So that is a risk. It's an ongoing risk again. And I'm going to give an example. And again, I'm not taking a position on this, but it's an example, and it's sort of what's happening in the automotive industry right now. With the very big focus on the Biden administration on green energy and electric vehicles, of kind of putting money towards this, but also putting restrictions and rules on it. So what's happened is, where there's been a lot of pressure, at least on the US automakers, has been the demand for these electric vehicles has not been as high as the government mandates or push towards producing them. The costs of producing them are much higher because, with the exception of Tesla and the other EV-only car companies, they have to restructure. They have to build batteries and source materials and have new factories and train their workers. So it's really challenging for them to make this big shift in a reasonably short period of time if they don't sell enough vehicles. And you're getting a lot of that pushback from the big three automakers in the US of saying, we don't have enough demand for this. We believe in this, we want to do it, but we're not selling enough vehicles yet. We don't, at this point, have it hit a very high level of the sale of EVs. I think, and I don't have the current numbers, so these might be off a little bit. States like California, which has the highest adoption rate, highest sales per population of EVs, is only in the teens. Most states are far below that. So we haven't hit a point now where they have gotten this mass popularity or mass desire. People are still primarily buying gas vehicles in the United States, and there's a lot of reasons behind that. But to make this transition a balance between attracting people to it and government support is a challenging place to be when you're trying to get it done fast. Again, I'm just stressing purely economic here and not getting into the aspects of EVs or climate change or anything like that, because that's really outside of my expertise. But I bring this up because we have to watch that too, because it does have an impact on stocks that can sometimes be rewarded unfairly, but also penalized through government policies. So I want to throw those things out there because those are sort of the bigger risks that I'm seeing. I'll go answer a couple more things and I'll jump into questions. The other biggie is real estate, everybody's favorite one. I think I'm going to bring a real estate professional into one of the upcoming webinars to talk about this in more detail than myself. Real estate, a lot of this you guys probably already know. A lot of people, and I don't recall the exact percentage, but it's a very high percentage of mortgage holders have a sub 4% 30-year fixed mortgage or shorter term fixed mortgage. Vast majority. Numbers, I forgot again off the top of my head what it is, but it's a very, very high percentage of mortgage holders. Very few have variable rate mortgages. What's happened though, these people don't want to move. If you have a mortgage and you're cruising around 3%, or you've refinanced a couple years ago and the rates were really low, or it's been that low for a while, what happens is you don't want to move. Because if you move, you're going to pay twice that, right? Plus or minus, depending where you're at, or more. So people stay put. Moving's expensive to begin with, notwithstanding taxes and all the other considerations if it's your primary residence. But those monthly mortgage payments doubling, plus or minus, is a big incentive to stay put, stay exactly where you are, even if you would rather move closer to the kids, closer to the grandkids, to a lower cost state, do any of these things, you're kind of stuck. So what that's done to housing is there's just not a lot of supply coming into the market. Don't forget the caveat, as all the real estate people will tell you, it's location, location, location. So different parts of the country are experiencing different things. Some parts of the country, they're building housing like crazy. It's stunning to see the numbers in Texas and South Carolina and other states, how fast they're building out housing because the demand is so great. Other states are more constrained by the cost of land, the cost of building housing, government regulations, policies around building in general. Generally, people not build houses if they're not going to make a return on them. If they're developers and individuals as well, it's very expensive to build housing in a lot of the country. California is a really good example. So that has slowed down the ability to build housing to keep up with the population demand. This has been going on for a long time. So essentially what we find ourselves in is we just don't have enough housing for the people that want it, even with these high interest rates, which is why housing prices are staying pretty high. Yes, there's been a pullback recently, but the housing prices are largely higher because of the demand issues. California had a net outflow of population. I think we just got the numbers of over, I'm getting really approximate here, 400K, 800 and something K left, 800 plus thousand people left California, 400 or so came in last reporting period. So you think, well, if all these people are leaving, how come we don't have enough houses? Because we haven't built enough housing for a long period of time. This has just been going on for a long period of time. Affordability as well. Look at the starting price for a house, especially in the Bay Area, Santa Cruz County, much of the state. It's very expensive to get into housing. And there's just affordable housing is not affordable to the majority of the population. So this challenge will continue, and that will likely, while housing prices likely decline, they're unlikely to crash or drop significantly unless we had an oversupply, which I don't see happening again, especially in California. The states experience a lot of inflow of population, same thing. They're not just simply not building fast enough. So the biggest challenge to housing really is the cost of building and the cost of rates. If rates come down, the Fed cuts rates and they get a little bit lower. If you're thinking of buying a house, it may, not advice, depends on your personal situation, a lot of other variables. It may be a time to look at it, especially if inflation comes back and they have to do this all over again in 2026 or so. With this and any other major financial decision, really important to consider your real estate as part of your overall financial plan. There are a lot of options out there and a lot of considerations to make if you're considering moving or buying or selling a property. It's really good to have a good team of, if you're financing, if you're not paying cash, good mortgage professionals, good real estate professionals, good financial planners, and also tax planning. All of that ties in together because sometimes you can afford more house than you think if you can optimize your taxes. Other times, selling a house could be financially tax-wise devastating. And so I didn't want to take too much time on real estate, but that was a question I got a lot of questions about with the real estate market. And locations really matter. So I was talking to clients in South Carolina, and they are stunned at the rate of growth. I've seen the rate of growth in Reno. North of Reno looks like San Jose now, exactly like San Jose. Breweries, the coffee shops, everything. I remember when Reno was this little dusty casino town in the middle of nowhere, and the casinos are now buried in the center, and all this growth around it. It's growing rapidly as companies are expanding. Now, to get past the question, which I had two of, about people leaving California or should leave California, I think I touched upon this one before. Where you live depends on a lot more than the cost of living. It depends on where you wish to be and where you need to be. There's a lot of variables that go into that. Personally, there's your choice, the culture, the climate, the people around you, your social networks, your work. There's a lot of factors that go in where you live. From a financial aspect, the important thing is, again, this should be done. We do a lot of out-of-state migration planning at Sequoia. So if you're thinking about it, we have a whole process to go through of how to evaluate the best place to live and how to factor in the total costs of all of it. Because it's an expensive process to move. It's also phenomenally disruptive, and you really want to make sure you're making the right choice before you make the final choice. And that, because again, there's a lot that goes into that. So definitely do some planning around it. There is no best state or worst state. There is no best decision or worst decision. It is a personal decision that goes on many, many levels. What you want to make sure of is you do it. If you do it, you do it right. Right. So you have the most smooth and easy and optimal outcome that you can have. So I covered the most important things here. I'm going to go into questions now. So again, more questions, send them across. I'll put my glary glasses back on for this part of it. I just want to make sure I'm getting everybody's questions. Also too, a couple of, before I jump into questions, a couple of things. This is your interaction time. If there are topics that you're interested in knowing more about, we have access to some very great national speakers, some amazing people. I will tell you, we got some good ones on deck for next year. Okay, they're going to talk about a lot of these subjects. So if you have a subject, if you had really love to have a deep dive in this, we will get some great speakers. We will bring them on these webinars or bring them in live, or both. We really want to make sure, again, you're getting a lot of value out of this. The other one is some two important little books that we will send you electronically for any of you who are interested. We really want to share them with you here. This is available to anyone who asks for it, client or not client. If you're a client, maybe you want to give it to a family member, one for yourself, just let me know. There are two. If you can see this clearly, if not, maybe I will just follow up with a picture because I'm realizing it's very glary. So this is called the Family Love Letter. This is a great tool to put with all of your important documents if the unthinkable is to happen to you. What it does is this does not replace a will or a trust. Stress this out. This is not a legal document. This is in addition to that. This is where you get to put all the other things, where you can fill this out to the degree you want to or don't want to. Sometimes if people just put in the more subjective things, why did I give my china to you? Why did I do this? Why, what's behind the things that are stated in my trust? Maybe some life stories around that. There's a lot of personal, people have put a lot of information in these little booklets. Also important things, where to find your passwords if you have your accounts online, where to find your healthcare director to trust. This is a really good book. And you don't have to put anything more in it than you want to, and you just put it with your important documents. Again, if you want it, called the Family Love Letter, let me know. Another one. This is really good. 10 conversations all families can have. This is really, really important if you're working with your next generation, working and creating a family values plan around finances or anything greater. It is an amazing book. It touches upon some very deep levels. A lot of subjectivity where it's very personal. You fill this out, but it's a great way to open that conversation with the next generation, as well as other people in your lives to the degree you want to use it. We're probably going to have a great webinar on this to go do a deeper dive. Any of you are interested, happy to send it to you again. It's a really great. We use this now a lot when we're working with families, because as I mentioned earlier, we do planning with the whole family. And by the way, when we do the planning with the whole family, we keep things pretty confidential. So we only share the information that you like. So if we've done your entire financial plan, we will talk to you in advance of what information can be shared in a family meeting. Oftentimes we will not share, like, say, specific financial numbers, but we may share high level planning things. That would all be discussed in advance. So confidentiality is key, but it is helping to prepare the next generation. As hard as we all try, parents are parents, right? And sometimes it comes a little bit different when it's done in a family meeting with an outside sort of facilitator in this. I don't want to give this too much time, because I know you all came here for the economic updates, but we will be getting into this more next year, because the reason we're doing all this, there's something more to it than the money, the portfolio value, all of the technicalities I'm talking about the greater economic picture. We're doing this to create the best life possible for ourselves, our families, and our communities. This is the purpose of all of this planning. So I really want to make sure everyone, again, is getting the greatest value in the heart, as well as the mind in the planning. That being said, I'm going to hop into questions here. Any more, just let me know. I'll start with these. If the entitlement programs are having a huge problems, what would happen for someone like me who's just starting to take Social Security at age 70? Would our age group be okay with Social Security? Highly probable. I cannot see any scenario with any politician that would take away what you already qualified for. Social Security is going to go through reform probably within the next 8 years. So think carefully on the election season. No, I'm just kidding. So where are we to vote for? And again, Congress more important than the president. These people are going to help facilitate how this is going to play out. I'm part of an economic group that we regularly meet and discuss a lot of economic policies in the United States. And believe it or not, the politicians listen to us. We actually they sometimes come in our meetings and listen to us for some of their policy formations. So that makes me feel really, really good. The rules of our group is no politics. We have to be solution oriented. So I know a lot of what's being worked on and talked about with Social Security. So everything I say is all working ideas. Nothing is finalized. This is going to play out probably over the next few years, but the programs are going to get modified and reformed. There is a solution for it, and I'll talk about that in a moment, but I want to answer this person's question first. There's no one talking about affecting or impacting Social Security benefits on people north of 50 or 55. I'll be 55 next month. No, just kidding. Anyway, it's really talking more about the younger generation and how this may impact them. I will tell you, when Katie and I do financial plans, we do not factor Social Security in for our younger clients. We're just being real cautious. It could look really different. And there may in the future be a means test based on your assets or income where your Social Security could potentially be impacted. But they're not going to touch people north of the 50s. And again, this is the working policy now. And even this is even the more, we're going to take all your Social Security kind of crowd, not because they understand that people have a very short runway to be able to plan for it. So you going in at 70, you're probably just fine. Again, can't promise that. I'm not the president. However, it's highly unlikely to be impacted. The things that are being talked about that seem to have the most traction are a combination of raising the Social Security, the income limits where they're taking Social Security taxes. So not going to the moon, right? Not all your income is a subject of Social Security tax, but just increasing that a bit. That will put a lot of money into the program. Also potentially bumping up the ages for the younger generation, because we are living much longer. Please remember that when Social Security was formed, right, in the early stages, most people died before they collected. Now people are easily living 20, 30, even 40 years into Social Security. Okay, it does happen. So people are collecting a lot longer. This is really what's putting these entitlement programs, why it's eating up more and more of the federal budget, is not the demographics. We're living a lot longer. They're keeping us alive longer. Healthcare advances are just making that possible. We're living longer. It costs a lot more money. Our population is growing, not shrinking. All of these things are an issue. So the program will likely be reformed. It will likely be for the younger people, and it may have a push out to age of collection, and it may have an income test limit. So it may shift more into a social safety net and less into you paid into it, you get it. There's a lot of variations of that. There's the more socialistic version, which is more that the government's just going to grab a lot more money from the wealthy people, and everybody's going to get more Social Security. Problem with that, there's not enough money there. There's not enough. I mean, you taxed all their money, it would hardly last. If you knew how much money was being spent on these programs, you realize that take it all from the 0.01% and you still can't fund the program very long. The other side of it is totally getting rid of Social Security and putting everyone's money in some form of the market or having more individual control over it. But given all the stories we hear about people not always making good choices with their money, as well as your entire future without a safety net being at the whims of the markets, the economy, that's unlikely to fly. It's probably going to be some variation in the middle. The greatest challenge we have is any politician, Democrat, Republican, Independent, doesn't matter, that talks about reforming Social Security or changing it, immediately the other side rips them apart and says, they're gonna take away your Social Security. And it doesn't see the light of day. So it's going to take a more moderate type of stance where they can pull together people from both sides to provide this solution. So, my fingers crossed we'll get that way in the upcoming years to be able to solve for this, because it will be solved for. It's going to be solved for by good policy, or it's going to be solved for by the markets, because the government only can issue so much debt. Which again, when I'm going to talk to you guys about the 2030s, saving that for next month, that's going to be the big when the chickens come home to roost. Have you heard anything on future taxing equity in a house as income? I'm not 100% sure I understand this, but I'll say how I think it is that you're looking at the equity in your home. So your home's worth 1 million, you owe 500,000, you have a $500,000 gain, taxing that on your taxes as they're currently taxing income. Theoretically, it's possible based on, again, that Moore versus United